Look, markets have had a very strong run, so it's natural that after a good few weeks you'd get a bit of give back. That said, we've moved from having 7 rate cuts priced in the US this year, coming into this year, to just 1. And despite that, markets have actually been pretty strong. And the reason for that has been that earnings remain pretty solid and the global economy is stable or maybe even picking up slightly. So against that backdrop, it makes sense to be broadly looking to be overweight equities, and actually you can get some pretty cheap protection either by being long the US dollar, which obviously has a positive yield and has proven to be pretty defensive, or even just using options to buy cheap upside or cheap protection. So that's the strategy that we're pursuing.
I wanted to ask you about Japan in particular. It's one of the loss leaders today. The house view on Japan is that, look, strong wage growth, downside pressure on the yen might actually allow for more policy normalization in Japan. The BOJ could hike rates more than expected as soon as next month. So what does that mean for risk asset positioning across Japan? It's certainly been one of the more interesting markets to watch through the course of the year.
So we do believe that the highest wage growth since the start of the 1990s and the downside pressure on the yen should allow maybe even 2 rate hikes this year, maybe 3 going into next year, which is more than markets expect. That said, the underlying fundamentals of the Japanese market shouldn't change that much, which is really good momentum in earnings growth, really cheap inflation-adjusted funding costs. Still rates are going to be way lower than in the US. And when we look at the valuations, say in the mid-cap space in Japan, really appealing in absolute terms and in the international context.